Hello, everyone. Good evening and good afternoon. Please do let me know that my voice, video, and screen all three are clear. Please acknowledge me that my voice, video, and screen all three are clear. All clear. Nice. Clear. Nice. Okay. Okay. Bismillahirrahmanirrahim. Rabbi shrah li sadri wa yassir li amri wahlul 'uqdatam min lisani yafqahu qawli. Rabbi zidni ilma. Let's start with the today's session. First of all, deep apologies for being late because I was having some official commitments and meetings, because of which yes, it's going to be in English. It's going to be in English because of some commitments and the personal commitments. I was busy somewhere else and I was stuck in some meeting. That's why I have to delete that session. But rather to cancel it, I thought that it is the right time to have this session. That's why I didn't postpone it. I didn't cancel it. But I really apologize for the inconvenience. Thank you so much for accepting my apology. Okay, let's start with the session. First of all, let me give you my introduction. Me, myself, Muhammad Junaid Khalid. I am the ACCA FR tutor, and I've been teaching that subject for the last 8 years, Alhamdulillah. And many of the students I've taught, and there are multiple results that we have secured so far. Okay, this session, in this session, what we are going to discuss, what is the agenda of the session, what we are going to learn in this session. So first of all, let me share the agenda of this session first. Now, in this session, what we are going to learn, we are going to learn and we are going to study, we are going to practice a few questions, and we will not be practicing it only, but instead we will be discussing it in the depth of the knowledge. Let me share you the how the examiner is being testing the exam, especially the FR exam. Initially, the ACCA FR examiner was very specific, and he was very specific with respect to the topic. For example, there are a few topics, and these topics were considered to be very important topics, and examiner were meeting the expectations of the students. Like, students were expecting that IFRS 9 will be tested. The students were expecting that there is another important standard, IFRS 15, it will be tested. The students were expecting that the consolidation will be tested. The students were expecting that the IFRS 15 revenue will be tested. And examiner was meeting the expectations of the students. But in the last 2 to 3 attempts, what I am observing, that now examiner is not meeting the expectations of the students. Like, there is a standard which is IS 41 agriculture. It's one of the most precise standard, very a short one. IFRS 5, it's a short one. IS 2 inventory, a short and a basic one, which is tested in the previous exams like financial accounting paper in FA1, FA2, in the foundation diploma. The examiner is testing that search topic from the scratch. That is, examiner is testing that particular topic in FA2 in financial accounting paper. So these are the topics, and earning per share EPS, that is IS 33. So these are the topics that the examiner was not testing. Why he was not testing? Because these were the very small standards, and similarly, students were not focusing on that areas. But now what I have observed from the last 2 to 3 attempts or the 4 attempts, now the examiner has changed its overall strategy. And now what the examiner or ACC examiner is doing, he is testing from every dynamics of the paper, from every part of the syllabus. You cannot expect that he will be testing from IFRS 9. You cannot expect it that you will get a very good question from IFRS 15. At times in the exams, what I have observed, what students told me, that there was not even a single question related to IFRS 9. There was not even a single question related to IFRS 15, but there was a complete OT case related to IS 41. Yes, a standard which has no length, a standard which the examiner was not giving any importance even. The examiner is testing for that topic even for the 10 marks. So what I want to tell you, that you can't skip any part of the course now. Every standard is important. You never know about it. That if you're leaving any standard, just keeping in your mind that it is that a very small topic and it is not that of an important concentration, examiner will not be testing it. So you are absolutely wrong. You have to prepare yourself for each and every area. Mark my words. You have to prepare yourself for each and every area. So that is something that you need to keep in your mind. Now, coming back, your paper pattern is the examiner will obviously testing you for three sections. That is section A, B, and C. Section A, B, and C. Now, there are three sections. It's not a game of luck. It's not a game of luck. It's something that you have to prepare. Why examiner is doing like that? It's not he's testing your luck or the fate, but the examiner, what examiner is doing, examiner wants you to prepare yourself for each and every area. You can't skip it. You can't skip it because this financial reporting paper is a very important paper. Yes, obviously, if you're not preparing it completely, it means you're taking a risk. You are now you are dependent on the luck. But examiner has given you the clear instruction that I can ask each and every standard, and I can ask from anywhere from the course. So it means you have to prepare it. Now, if you talk about the paper pattern, so the paper pattern is like that. Examiner will be testing you in three areas like section A, section B, and section C. So examiner would be testing you in these three areas like section A, B, and C. We all know that section A is basically a MCQs based area. It's an MCQs based area in which there will be 15 MCQs that will be tested, and each MCQ will carry 2 marks. So it means the aggregate weightage of the section A would be 30 marks. In section B, OT cases will be tested. I'm not going in detail that how it will be tested. Definitely, we are going to practice it today. 3 OT cases will be tested. Each OT case will carry 10 marks. In which case 1, there will be 5 questions. There will be 5 questions. Each question will carry 2 marks. So it means the case 1 weightage would be 10 marks. Similarly, case 2 and similarly the case 3. So it means 3 cases, and obviously the weightage of the section B would be 30 marks. Now, why I'm showing you that paper pattern, that what I believe that the area that will help you out to pass your exam, the area that will help you out to clear this exam is not and one and only is section A and B. I repeat, this area will help you out to clear your exam. Yes, the aggregate weightage of the section A and B is 60 marks, and this is something which is doable. Remember, mark my words. Hold on. Wait. Hold on. I didn't said that you are not supposed to prepare for the section C. I'm coming to that particular point. What I said, if you want to clear, if you want to pass your exams with ease, if you want to pass your exams with comfort level, so it means section A and B will help you out to pass your exam. How this area will help you out, that out of 60, if you are able to secure even the 40 marks, and it's a doable task. Mark my words. Mark my words. It's a doable task. You can do it. If you have prepared yourself, if you have done all the practice questions, if you have done all the practice material, the official resources, if you have done with all the resources provided by a tutor, so there is no reason behind it that you are not able to secure 40 out of 60 marks. You can easily. I'm giving you a maximum leverage on this one. That out of 60, you have the chance to skip 20 marks. You can go for wrong. You can answer wrong questions till the to the 20 marks. It means out of 60, 40 marks to secure. It's not a big deal. It's not a big deal. Now, if you want to pass this exams, obviously, out of 60, if you have secured 40 marks, you just need 10 marks out of 40. 10 marks out of 40. It means in section C, out of 40, in order to secure 10 marks, it's not a big deal. Financial reporting paper is that kind of a paper that you can pass it in your first attempt if you're having a right strategy. What the people are doing, what students are making the blunder, they are giving the utmost efforts to the section C while keeping section A and B behind the rocks. This is something that you're making a blunder of it. If you will give the 100% efforts on the section C, I can guarantee on this one that you will not be able to secure more than 20 or 25% marks. Will this area be able to get you passed from the papers? This will not be. So it means the area that you need to prepare very stronger is section A and B. But again, mark my words, I didn't say that you will be skipping at section C. No, 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 no. Remember, A and B will take you to the borderline. That is 40 marks. Still, you need 10 to 15 marks to clear your exams. If you're securing 35 marks, so you need 15 marks. If you're securing 40 marks, so you need 10 marks. So it means that 10 marks you can get, and you can get those 10 marks easily from the section C. How? Let me give you an example. In section C, you must have observed from the past paper analysis that examiner is testing for the question, that is the ratios. And mark my words, it is like a mandatory question that the examiner will be testing. It is like a mandatory question that the examiner will be testing. Yes, although it is not officially prescribed by the examiner, although the ACCA examiner has not revealed it that it is officially be tested, yeah, or it will officially be tested. But in the past paper analysis for the last 3 years, what I have observed, that the ratio question is the examiner's the most favorite area that he will be testing, and he will be testing for approximately 16 to 20 marks. Yes, and out of this 16 to 20 marks, it's quite easy to secure 10 marks from this question only. You know that in section C, the examiner will be testing for the two questions that is of 20 marks each. That is of 20 marks each. One question that I'm expecting is the ratios. And you will obviously be finding out that particular question in your paper. It's guaranteed. It's like a guarantee. It's a batting one that I can bet on this one. The ratios question will be tested. The other one could be a choice. It could either be a final account. It could either be a consolidation. Sometimes it's a merger of. So it means that in the other question there is a confusion. But obviously ratios will be tested. Now, in that ratio, the simple requirement is to calculate the ratio. Yes. And this calculation of ratio is quite simple. And this normally carries 6 marks. And the calculation is quite simple. There is no, even in the examiner reports, I have always read it out that examiner states that these were the most easiest marks, and examiner appreciates the students over there that most of the students did it perfectly. So it means that 6 marks is most important and easiest marks. You can easily secure 6 out of 6. Remaining 14 marks is for your analysis. And mark my words, examiner is very, very lenient in your ratio analysis area. He's very lenient. He is not expecting a lot from you guys. This is something that the examiner has stated. That the examiner has stated in their report that we are not expecting a lot from the students. This is not the professional level exam. It's a skills level exam. Yes, examiner will be expecting a very good drafting skills in your professional level. That is SBR, SBL, P4, P5, or whatever the option you select. So examiner will be expecting a lot from your professional exams in the professional stage. But right now, examiner states that we are not expecting a lot. And for that purpose, how to attempt this ratio question, how to attempt the analysis, I have made multiple videos on it, and I've given you few guidelines, the shortcuts, that how you can attempt that particular question, how you can attempt maximum marks out of it. And with this, many of the students have applied, and what they said that we have written nothing but the basic guidelines that you have given. And once we received the examiner feedback, out of 14, we secured 7 to 8 marks. And that student told me that I promise, I swear, I didn't write anything except for the basic points. So it means if you're writing those basic points, you can secure 6 to 7 marks. So what I said, yes, I can provide you the link after the session. I'll be sending, or I'll be sharing my contact number and my email ID as well. And there is some announcement that I would like to give you, that uh, I'll be giving you a free resource that you just send me your interpretation. I will check it by my personally, and I'll give you the feedback and the comments that how's your preparation, how's your comments, how's your drafting skills, and what shortcomings are there and how you can improve it. So obviously I can provide you this facility as well. So I will be sharing my contact number or my email ID at the end of the session. Yes, 40 plus 7. It's not 7, brother Muhammad. It's not 7. 6 for the calculation and 7 for the interpretation. So it means with reasonable efforts in section C, you can secure, you can pass your exam. But obviously we are not here to just pass your exam, we are here to secure more good marks. For that, obviously there are other areas like final account, the consolidation, and the better you will perform in the other question, obviously your chances of success rate will increase, your marks will increase, you can secure marks in 17s and 80s. So the point is, in the first half of the session, what I want to give you a confidence that you can pass this exam. But for that, what you have to do, what you have to do, what you have to do. Yes, Mansoor, I'll be sharing it. Don't worry. Abu Bakr, I have made a very good video on it, which I've given you a very simple guideline. It's like a very baby steps that I've given over there, that how you can comment and without giving an extraordinary efforts. You will not be required, because examiner is stating that we are not expecting, these are not the analysts, these are not the people who are working professionally, or they are not working in the professional and the corporate life, they are not the financial analyst. So obviously examiner understand this one. So I have given you in that particular video, I have shared different aspects, that what basic thing that you can write on this particular ratio analysis question, so that you can secure maximum marks out of it. By this, once you will watch that video, I can guarantee on this one, inshallah, you will be able to secure out of 14. If the comments pass is for 14 marks, so you can easily secure around 10 marks. You can easily secure around 10 marks. And if you will practice more and more, if you will attempt more questions, obviously this quantum of marks will increase. Okay, so one thing that we have highlighted and one thing that we have come to the point is that section A and B is most important. This will give you, and this will give you a chance to pass your paper. If out of 60 you're securing 40 marks, it means you are about to pass the paper. Rest 10 to 15 marks, it's not that a difficult one to secure from section C. Obviously, I'm not telling you that you will be securing only 10 or 15 marks from the section C. Obviously, out of 40, you will be trying to attempt 20-25 marks minimum, so that you can secure good marks in your financial reporting paper. Now, in order to enhance your section A and B area, what I have done today in this session, that I have always, whenever I conduct a practice to pass webinar, what I believe, what I do, that I always discuss the examiner report. I don't know whether you guys have an idea or not, but ACCA usually reveals an examiner report on a half-year basis. That is twice in a year, like in June and in December. In that examiner report, ACCA highlights the most difficult areas. Yes, I repeat, the most difficult areas, or the most difficult question in which the examiner, you must read those articles. If you don't have the examiner report, so please do let me know at the end of the session. Once I will share my contact, so you can let me know, that I can share you that particular raw examiner reports, and you can see, and these are openly available. Definitely you can download it from your internet. In these reports, examiner highlights the most difficult question, and examiner has stated that these were the most challenging question. Remember, for section A and B, we don't have any past paper question. We don't have any past paper. For section C, yes, we do have past paper question that examiner might have tested in the previous exam, so you have the sample of it. But for section A and B, we don't have any past paper. Yes, we do have some resources like PPP kit, we have Kaplan kit, we have study of practice questions, quizzes. Obviously, these are the official resources provided by an ACCA, but we don't have any past paper for section A and B. That is, official past papers are not available by an ACCA. But ACCA reveals few questions, and the questions which are most challenging and the most difficult questions. And in that examiner report, ACCA examiner highlights that these were the more challenging questions, and majority of the students around the globe were not able to attempt those questions. So in this session, I'm going to discuss those particular difficult questions, and I'm not only going to discuss those questions only, but I will also discuss the areas, or I will also discuss the relevant standard, that what was the background. I'll be giving you a certain or a limited summary of that particular standard from the area it is tested. Are you clear on this one? Yes, Almas, obviously I'm going to discuss it as well. Mohammed, at the end of the session, I'll be sharing you the contact number so we can have the discussion on this one. Okay, don't worry. Now, let's start with the latest. In the books, Wajiha, in the books I have shared, and these are the volume B. Yes, volume B. There are in volume B there are certain questions related to past paper, and there are certain other questions. The past paper questions you can access from your practice platform. From platform, ACCA practice platform. Obviously through your my ACCA account. Through your my ACCA account, you can refer practice platform. Practice platform. In this practice platform, uh, plat- in this practice platform, you will be able in this practice platform you will be able to attempt past paper questions for section C. And there are other resources as well, that is mock exams, specimen, and the practice exams. So there are different resources which are available on your practice platform. You can go through that one and you can attempt the questions from there. Okay, now let's start with the latest attempt. Okay, for your kind information, that the examiner report that we are going to discuss is for the March and June 2025, which is the latest one. Mansoor, the questions that we are having in the practice platform are the most difficult. And remember, these are the questions that are beyond or above the benchmark. Yes, ACCA, all official resources that are available, that is on the practice platform. These are the most difficult questions. No, there is no argument on it. And obviously, once you will prepare yourself for above the benchmark, and I have seen this thing and what I've observed, that once you practice the most difficult question, the exam situation would be easier for you. There are two approaches. Either you practice for the easiest question, and once you will appear in the exams, if there is only a single question which is the difficult one, obviously you're going to panic it out. But if you have practiced for the most difficult questions and the examination situation is the moderate one, so obviously this is going to be a very good situation for you and you will be attempting that paper with ease and confidence. So obviously this is always being a criteria. The practice, the word practice will always be above the or it should always be above the benchmark. Okay, now for your kind information, we are going to discuss the examiner report that is related to March and June. For previous reports like December 24 or June 24, I've already made some videos and live taken live sessions on those examiner reports. So obviously I have compiled all of these difficult questions at one file, so I can share all of these files with you along with the answers, along with the explanatory videos as well. So we can I can also provide you with that one, no problem. Now let's start with the Okay, now let's start with the question number one, and I have started to receive the answers for this one. But obviously, we are going to discuss it. We are not just going to jot it down, or we are not just going to correct mark the answers. We are going to discuss it as well. Now, question number one: Pfizer company has leased motor vehicles, laptop, mobile phones during the current financial year. Pfizer company has no other leases. Okay. Now, while reading the situation or the question, first of all, you guys let me know that from which standard this question has been taken. We'll come to the answer later on. But my point is not to mark the answer in this session. We're going to have a very good discussion on the standard. So it is going to be a practice to pass. That is, this standard or this basically the session or the webinar is for your revision purpose as well. Very good. Nice. IFRS 16 leases. Now, let me give you an understanding before we move on towards the question of the requirement. In IFRS 16, there are two types of lease that we'll be discussing it about. That is IFRS 16. There are two types of leases. Number one is the finance lease, and the other one is the operating lease. Finance and the operating lease. Now, IFRS 16, earlier it was IAS 17. If you remember, IFRS 16 states that all leases should be classified as finance lease. Remember, the straight straight statement is that all leases should be classified as finance lease, except there is an exception. Except, now in this exception, there is an option. It's not mandatory. It's not mandatory. It's not mandatory. Yes, you will get the recordings of it. Don't worry. Except there is an exception that if you want to classify certain lease as an operating lease, so you can. Now, what is that exception? Number one, if it is for a short term. If it is for a short term, it means you have taken an asset on a very short term. And what is the definition of the short term? That is less than 12 months. That is less than 12 months. So if you have taken the asset on lease for less than 12 months, that is short term basis, so this will be considered as an operating lease. Number two, that if the asset is of low value item, if the asset is for low value item. Now for low value item, there is a criteria which is less than $5,000, which is less than $5,000, which is less than $5,000. If you are having an asset on lease which the value for which is less than $5,000, or if the asset has a lease term of less than 12 months, so you may, remember, there is not an obligation. You may classify as an asset as an operating lease. You may classify that lease as an operating lease. And obviously, there is a difference in treatment between the finance and the operating lease. In finance lease, obviously, the right of use asset will be transferred, the ownership will be transferred, and the asset will be recorded in the books of lessee. But in case of the operating lease, obviously, the ownership and the asset will not be transferred in the books of a lessee company. Instead, the lessee company will only recognize the rental expense. Okay. Now, so operating lease, you have two options. If you want to recognize a lease as an operating lease, again, there is a condition may. It's not absolute, it's not mandatory, but there is a condition that if the lease is for short term, that is for the less than 12 months, you can classify that lease as an operating. Or if the lease is for a low value item, that is less than $5,000, you can also classify that lease as an operating lease. But one thing that you need to remember or understand, that if in operating lease you have classified the lease on the basis of short term, on the basis of short term, so what you have to do, you have to classify the class of asset as an operating lease. Let me give an example for this one. And if you have classified the lease as an operating lease on the basis of low value item, so obviously you will classify that operating lease on a lease by lease asset. Lease by lease asset. Lease by lease asset. Now let me give an explanation for this one. Just leave everything. Please listen to me very carefully. For low value item, the IFRS 16 has identified few assets with the name which could be considered as a low value item. Number one, computers, laptop, laptops, tablets. So these are the assets which IFRS 16 has identified as a low value item. Telephones, right? Very good. Telephones, different assets. So there are different assets which the IFRS 16 has identified as low value items. These are all the low value items. Low value items. So these are the assets which are considered as low value items. Now, there's another question, that if the asset is of low value item but it is for more than 12 months, so obviously either of the criteria, Mansoor, either of the criteria should be fulfilled. Either it could be a short term basis or it could be a low value of it. It is not necessary that both the criteria should be met to recognize the lease as an operating lease. No, it is not the case. It could either be a short term. For example, the period is for 7 months, but the value is $7,000. You can classify that lease as an operating lease. Or vice versa. For example, it's a period for 3 years, but it's a laptop, it's a tablet, it's a telephone, or the value is less than $5,000. So obviously you can classify that lease as an operating lease. Mansoor, I hope that I'm clear. Now, if you have recognized the lease as an operating lease, but it was on the basis of short term, so now what you have to do, you have to recognize the class of asset as an operating lease. For example, if you have bought computer, so all computers should be classified. Computer 1, computer 2, computer 3, all computers should be classified as operating lease. You cannot state that computer 1 is classified as operating lease while the other computers are classified on the finance lease. No, whole class of assets should be classified as an operating lease. For example, you have bought 10 tablets. 10 tablets. You said that two tablets, and uh, these tablets were leased on a short-term basis. For example, if you have bought an asset on lease on the basis of short term, so what you have to do, you need to classify all the tablets, all the computers, all the tablets and computers in operating lease. You will classify all the assets in operating lease. But if you have any asset on operating lease which is based on low value item, so now you will recognize lease by lease asset. For example, you have bought computers. So if the computer is recognized as an operating lease on the basis of the low value item, now what you will do, you can classify computer 1 and 2 as an operating lease. The other computers you can classify as finance lease. Let me give an explanation for this one. One more explanation for this one. Listen to me very carefully. For example, I bought a machinery on lease. I bought a machinery on lease, and the lease period is for 10 months. Now, you guys please do let me know whether I can classify that machinery on as an operating lease. Yes, it's for short term. Okay. So if I have bought, let's say, five machineries, if I have bought, let's say, five machineries and it's for a short term period, now what standards recommends me that you need to recognize all of these five machineries as an operating lease. Why? Because you have classified that particular machinery on operating lease on the basis of less than 12 months, that is a short term period, that is on the basis of short term period. So obviously now what you have to do, you have to recognize all of these five machineries as an operating lease. But let me give you an example. Let's change the example. For example, I bought, let's say, 10 computers of different generations, let's say, and I bought these 10 computers on lease basis, and these were recognized as an operating lease on the basis of low value item. Low value item. So obviously on the basis of low value item, can I recognize that computers on the basis or as an operating lease? Can I recognize those computers as an operating lease? Yes. Exactly. So yes, I can recognize that computers as an operating lease. Now, what standard says that since you have recognized those computers as an operating lease, but the ground was the low value item. So now what you have to do, that you can recognize, let's say, seven computers under operating lease. You can recognize seven computers on operating lease. Remaining three computers which you think that should be recognized as a finance lease, so yes, you can do it. Why? Because once you're recognizing any lease on the basis of low value item, so now you can recognize the asset on lease by lease basis. It means fewer assets could be recognized as an operating lease, the other assets could be recognized as a finance lease. Are you guys getting a point? So this is very important. Yes. Exactly, Mohammed. Now let's come back to the question now. Let's come back to the question. I told you that we are not here to just solve the questions. We're going to have some understanding and the basics of that particular question as well. Now, which two of the following statements, by the way, if you just look at the example that are given by the examiner, and remember, these are the most difficult questions. The examiner has stated that these are the most challenging question. Majority of the students were unable to correct this question. Motor vehicle, is this the example for operating lease given by the examiner? No. No, obviously, this is not the example for, yes, laptop, mobile phones. Are these are the examples for the operating lease? Yes, absolutely yes. So obviously these are basically the examples of the operating lease. Now, okay, it means there are few assets which are straight away related to the operating lease and few which are not related to the operating lease. But let's read the requirement. Which two of the following statements regarding the recognition exemptions? Remember, IFRS 16 states that all leases should be classified as an finance lease. All lease should be classified as a finance lease. And yes, there are few exemptions. It means if they are asking about the exemptions, so it means here the examiner will be discussing about the operating lease. Am I right? Okay. Now let's move on. Okay. A lease that has a term of 12 months. Sounds good. Yes. If you're having a lease that is of 12 months or less, must be expensed on a straight line. What is the problem in that particular statement? What is must? Yes, Mohammed. Very good. Excellent. Here, the must should not be used. You cannot force. Even IFRS 16 states that if you are having an asset on lease and it is of low value item, it's for a short period of time, you can still classify that asset as a finance lease. There is no mandatory requirement. So it means here the point here, the wording must is absolutely wrong. Are you guys getting the point? Okay. Second, a lease that has a term of 12 months or less. Yes, here we go. The cuteness of this statement may be expensed out on a straight line basis or other systematic basis over the lease term. Yes, because we record the rental expense. So we can obviously, for example, paid if the total agreement is for 20,000 for 20 months. So we can expense out daily on a monthly basis as 10,000. Are you clear on this one? Yes, Mansoor, absolutely right. Okay, so B is seems to be a correct option, but we need two options, right? The second one, the phaser company can apply the exemptions for low value underlying assets to all its new leases. Are we going to apply on all the new leases? It's wrong. D. The election for the leases for which the underlying asset is of low value can be made on lease by lease asset. Is it correct? For low value item, it is lease by lease asset. Yes, you can classify fewer asset as an operating lease. You can classify fewer asset as a finance lease. So is this the correct option? Yes. Very good for those who already answered B and D. And I was seeing that many students answered B and D. Okay, now let's move on towards the next question. Next question, it's a question number two. Uh, First let's read the question, the data, and then identify that from which standard this is being taken. Now, uh, offer company acquired 80% of Bin's ordinary equity shares on 1st January 2004 when Bin's company's retained earning were 4.2 billion, $2 million. Offer company measured the non-controlling interest at fair value at the date of acquisition is 3.2 million. It's one of the very good question. Extract from the financial statements are as follows. Offer and Vince Company, the financial position is given over there. Equity section is given. Capital retained earning revaluation surplus. And here the statement is given over here that the Vince Company revaluation surplus is 2.6 million arose post acquisition. So it means all of the revaluation surplus of the Vince Company, that is a subsidiary company, is the post acquisition one. It's a post acquisition one. From which topic this question has been taken? Yes. Yes, it's a consolidation one. It's a console. Nice, very good. Now, what we have to do, a simple requirement is that you need to match the correct amount of the items in the group accounts with respect to the financial position. And basically, there are two things, that is the revaluation surplus and non-controlling interest, that we need to calculate. And in paper, what you have to do, you just need to drag and drop. That for revaluation surplus, whatever the four out of four amounts that you think that is correct, you should click on that one and you will be dropping it towards the revaluation surplus box. And for non-controlling interest, you will be again dragging and dropping it over there. Are you clear with this one? Okay, there's a request that first we should try this one. Okay, you can definitely try this one. Let me give you a few minutes and you just read the question. Try to solve this one. Calculate the group revaluation surplus. Let me give you a hint that you need to calculate the consolidated. You are going to prepare the consolidated financial position. So obviously you will be calculating the group revaluation surplus as well as the non-controlling interest that will be recorded in the consolidated statement of financial position. Okay, let me give you a few time. Let's say 2 or 3 minutes. You just try to solve this question and then I will resume it. Yes. Have you guys done it? Okay, we'll check it. Okay, 4.9 is the revaluation surplus and 4.4 is the NCI. Okay, we'll take it. Let's check it out. Okay, let's check it out. Let's try to solve this one. Okay. First of all, let's start with the beginning. What I told you that I'm not going to only solve this question. I mean, we are going to discuss it so have a better understanding of it. Offer company acquired 80% of Bin's company. It means obviously Offer is going to be a parent company and Bin's is going to be a subsidiary one. And here's the 80% acquisition, which shows that there is a control, and obviously the parent company has a control over the subsidiary company of 80% now. On 1st January 2004, that is the date of acquisition, when Bin's company's retained earning were 4.2 million, and this shows the retained earning at the date of acquisition, and which is also known as pre-reserve. If you guys have an understanding of it, so this is also known as pre-reserve of 4.2 million. That is the pre-reserve. Okay. Now moving on, offer company measured the non-controlling interest, that we are going to use the non-controlling interest, that is we are going to calculate the goodwill, or the company is using, or the group is using the fair value of NCI, that is fair value of non-controlling interest at the date of acquisition was $3.2 million. Okay. Now, there is a financial position extract is given over here, the share capital of parent and a subsidiary company, retain earning of a parent and a subsidiary company, and obviously this is basically on the date of reporting. And the revaluation surplus of the parent and the subsidiary company at the date of reporting. At the date of reporting is 2.6 million. And one thing that is identified over here is that the revaluation surplus, which is stated over here for 2.6 million, it's not a pre-reserve, it's a post-acquisition reserve. It means that revaluation surplus of a subsidiary company arose after the date of acquisition. And remember, whenever the revaluation surplus or any reserve that arises after the date of acquisition, this will be treated as a post-acquisition, and this should become the part of your consolidated accounts. It means this will appear in your consolidated statement of financial position. Yes, if this had been a pre-reserve or this revaluation surplus existed at the date of acquisition, so obviously we would have taken that revaluation surplus in order to calculate, or while calculating the goodwill, so we must have not taken that particular revaluation surplus in the consolidated accounts. But since this revaluation surplus is a post acquisition one, so we are going to recognize it in the consolidated accounts. Now, match the correct amount. We need to calculate two things. Number one, the revaluation surplus and the non-controlling interest. First, let's calculate the revaluation surplus. And remember, we are not going to calculate the revaluation surplus, but we are going to calculate the group revaluation surplus. Yes, we need the consolidated revaluation surplus. And remember, whenever we use the word term group, group means what? It's a parent plus subsidiaries post acquisition 80%. Yes, it's a complete definition. Whenever we talk about the group, whenever an examiner asks you for the group, so it means the group means the parent plus subsidiaries post. Yes, there are three elements. Number one, subsidiary. Number two, post acquisition, and not the 100%, but the 80%, because that 80% will be the part of your group, remaining 20% will be the part of NCI. Let's repeat it again. 80% will be the part of group, remaining 20% will be the part of NCI. Yes. Now, subsidiaries post acquisition reserves, subsidiary post acquisition reserve, subsidiary post acquisition reserves, and obviously this will be taken at 80% in the group. Now, so in order to calculate the group revaluation surplus, first of all we need the revaluation surplus of a parent company, and let's see whether we have a revaluation surplus of parent company as we have or not. So yes, for revaluation surplus, we have revaluation surplus of 2.8 million. 2.8 million, that is the revaluation surplus of a parent company, yes, it's 2.8 million, right? And now we need the subsidiaries. We need the subsidiaries revaluation surplus. We need the subsidiaries revaluation surplus. And what, which revaluation surplus? We need the post one. And remember, this post will be included at 80%. Why? Because 80% will be included in the group. The remaining 20% will be included in NCI. So if there is any post revaluation surplus, yes, it's quite and clearly stated that the complete 2.6 million, it's a post acquisition revaluation surplus, and obviously we are going to add up at 80%. So any one of you please calculate the 80% of the 2.6 million. 80% of the 2.6 million. 2.6 million 80%. Yes. 2080 or 2.08. 2.08. So the entire revaluation surplus of the group is going to be 2.08 plus 2.8. This will make 4.88 million. This will make 4.88 million. Now let's see revaluation surplus 4.88 million, which is nearest to 4.9 million. So rounding it off to 4.9 million. So we are going to select that particular box and we'll be putting it up. That means that 4.9 million is the group revaluation surplus. Are you guys clear with this one? Please do let me know. Is there any? Yes, rounding off to 4.5, 4.9 million. Okay, great. Now let's calculate the value of NCI. Let's calculate the value of NCI, that is the non-controlling interest. First of all, let me tell you that what elements that we include and what is the definition of NCI. NCI is basically a portion of a subsidiary at 20%. Yes, it's a subsidiaries portion at 20%. And obviously, while calculating the NCI, we're not going to account for the parent's area. So NCI is subsidiaries 20%. First of all, we include the fair value of non-controlling interest at the date of acquisition, which was obviously given in the question. And this was, I think, 3.2 million, right? Yes, it's 3.2 million. So first of all, the fair value of NCI at the date of acquisition, that is 3.2 million. Then again, we add subsidiaries, post acquisition retained earning. But obviously, this will be included at 20%. And don't forget to include the subsidiaries, another reserve, which is the post acquisition revaluation surplus. And obviously, this will also be included at 20%. So, the learning outcome of this question is yes, if there is a post acquisition reserve, that is a revaluation surplus, this will also become the part of your NCI. Yes, this will also become the part of your NCI. Now, retain earning at the date of acquisition and at the date of reporting. So at the date of reporting, the retained earning was 7.6 million, and at the date of acquisition, it was 4.2 million. So 7.6 minus 4.2. 7.6 minus 4.2, and obviously the resultant will be taken at 20%. Yes, any one of you can please calculate 7.6 minus 4.2, and the 20% will be calculated. Yes. LO means learning outcome. Learning outcome. The learning outcome of this question is that we have to take the post acquisition revaluation surplus in NCI as well. But yes, if it relates to the subsidiary company, obviously, if the revaluation, the post acquisition revaluation is related to parent, so obviously this will not be the part of NCI. So it's 0.68. It's 0.68. Okay. Now, uh, subsidiaries post acquisition revaluation surplus. I think the post acquisition was 2.6 million, and obviously 2.6 million multiplied by 20%. Yes, any one of you? 2.6 million. Yes, Mansoor. Why? Because revaluation surplus and retained earning and as well as the share premium. These are all reserves. These are all reserves. These are all reserves. 0.52 million. 0.52. So if we add up all of these values, 0.52 plus 0.68 plus 3.2, 3.2, so this will make 4.4 million, right? So yes, this 4.4 million, this 4.4 million, yes, this will be considered as non-controlling interest. Are we clear on this one? Yes, Mansoor, it's so easy. But remember the questions that we are discussing right now, examiner has highlighted that these were the most challenging questions. And what could be a challenge? The learning outcome and the challenge in this question was majority of the students didn't incorporated the revaluation surplus while calculating the NCI. So the learning outcome of this question is that if there is any post-acquisition revaluation or any post-acquisition share premium or any other reserve, so obviously this will also be incorporated in the NCI. Now let's move on towards the question number 3. Again, great. Now let's move on towards the question number 3. Question number 3. Delek and Ribim Company are competitors within the same industry and are in an inflationary economy. Inflationary economy. And what is inflationary economy? That the prices are rising. Delex company's profitability ratios are consistently higher than the ribbon. It means that Delex profitability is more than the ribbons companies. Okay. The two companies accounting, and remember, they are both operating in the same industry. The two companies accounting policies are consistent except for the inventory and properties. It means that all the accounting policies are consistent, but they have made certain changes in the inventory as well as in the property. Identify by clicking the relevant boxes in the table which company each of the following accounting policies it belongs to. Now remember that the Deluxe profit is more than the ribbon company's profit. Now there are two statements which are given over here. You need to identify that for which company the statements are true. Okay, number one is for Dalek and second one is for ribbon. Nice, very good. Okay, Almas is having a different opinion. Mansoor, Dalek and ribbon. Okay, Muhammad. The first one is the Dalek. What about the second one? Second is for ribbon. Okay, nice. Now let's discuss. Let's discuss it. Okay, second is for review. Now, that's why the examiner said that these are the most challenging question. Mansoor, these are the most challenging questions. Here is the confusion now. Let's have a discussion on it. Using the FIFO method. Now, first of all, here IAS2 is being tested. IAS2, yeah, right? FIFO, FCO, LIFO. So it means in this question, basically the examiner is testing the basic knowledge of IAS2. And obviously in the second statement, the examiner is testing a basic knowledge of IAS16. Now, IAS2, FIFO method rather than the weighted average. You must have learned about this one that in case of the rising trend or the inflationary trend, whenever you are in inflationary trend, so FIFO method will show a higher profit. If you're using the FIFO method, so obviously FIFO method will show a higher profit. FIFO method will show higher profit. Show higher profit. So in this statement states that use of FIFO, that is first in first out method rather than the weighted average method for calculating the cost of inventories, which means that if you're using the FIFO method, so obviously the profit will be higher. And in the above statement, we have seen that the Dalex company's profitability ratio is higher, which shows that clearly states that obviously this statement is applied by Dalek company. Majority of you has given the correct answer for this statement. That the Dalek company, this statement completely suits the Dalek company because it is possible that they might have used the FIFO method because of which the profitability ratio is higher. Now, second statement, use of cost model, that the company is using the cost model. Now let me give you an analysis on this one, that if you're using the cost model, for example, the cost of the asset is 100,000 and the life is, let's say, 10 years. And while using the revaluation model, the value of asset is obviously higher, and that is, let's say, 200,000, and the useful life is obviously, the remaining life is 5 years. Now, if you calculate the depreciation under the cost model, so you will see that the 10,000 depreciation will be calculated while using the cost model. And if you're using the revaluation model, so obviously 200,000 divided by 5, so the depreciation amount would be 40,000. Now, in which method the amount of depreciation will increase? In which method the amount of depreciation will increase? In which model? Obviously, in revaluation model. In revaluation model, the amount of depreciation would increase. So here it states that the company is using the cost rather than the revaluation model. It means if you are using the cost model, so it means the depreciation is 10,000, assuming, and if the depreciation expense is 10,000, which means as compared to the revaluation model, the amount of depreciation is lower, and obviously if the amount of depreciation is lower, so the profitability would be higher. The profitability would be higher. Yes, which indicates that if the high profitability, the direct company is using the cost model, because of which the expense, the depreciation expense is lower and the profit is higher. Are you guys getting the point? So Almas, you are absolutely right, mashallah, very good. So both the statements, both statements relates to the direct company. Yes, Mansoor, why not? This is for you. That here in this statement, use of cost, it says that company is using the cost rather than revaluation. The company is using the cost rather than revaluation model. So now we need to identify that for which company this statement suits. If you're using the cost model, so obviously the price or the value of asset is lower and the life would be 10 years. And we know that when we are recording the asset at its revalued amount, so obviously the value of asset would be higher, and we always depreciate the asset over its remaining useful life. So obviously the denominator part would be lower and the numerator part would be higher. So obviously the resultant would be higher, which means the depreciation expense is 40,000. So if the company is using the cost model, so obviously the amount of depreciation would be lower as compared to the revaluation model. Number two, obviously if the amount of depreciation expense would be lower, so the profit would be higher. So it means, which means that this second statement is quite suitable for the Dalek company. Are we clear on this one, Mansoor? Okay, now question number 4. It's for a theoretical one. And I would like you all to please participate. Yes, Mansoor, this is something very important, that if you have highlighted or if you have marked one statement as correct and the second one is incorrect, so remember that entire question will be marked as incorrect. So you'll not be getting 1 mark for that particular question. So entire 2 marks will be lost. Okay, question number 4. Like in this, two statement you need to identify. If you have identified one statement as correct, the other one is incorrect, so obviously you will not be getting any marks of it. That's wrong. Whatever you say, you are in ACC program. Okay. Now, the second question number 4. Question number 4. Now, this question is related to the conceptual framework. This question is related to conceptual framework. Yes, please read the question and try to answer it. Which two of the following statements, which two of the following statements regarding the International Accounting Standard Board conceptual framework for the financial reporting are true? Number one, it assists all the parties to understand and interpret the IFRS. Is it true? Yes, it's A. Nice, very good. A is correct. Yes, it represents. We have seen this thing. We must have seen this thing that conceptual framework assists you, and even they assist the preparers to develop the new accounting standard. Second, B point, that it does not override any IFRS. It does not override any IFRS. It does not override any IFRS or any requirement in the IFRS. True or false? Okay. Uh, let's mark it for the subsequent discussion. C. Many of the students are saying that C is correct. Okay. It introduces the enhancing qualitative characteristics for the relevance and faithful. Now there is a blunder. If you remember that we have qualitative characteristics, yes, qualitative characteristics we have. There are two. That is number one, the fundamental. Number one is the fundamental, and second one is the enhancing. There are two, fundamental and enhancing qualitative characteristics. In fundamental, there are two basic components, that is the relevance and faithful representation. So there is a blunder in this statement, that it says that it states that it introduces the enhancing qualitative characteristics of relevance and faithful. So sorry to say this one, but the in relevance and faithful representations are not the part of enhancing, either they are the part of fundamental. So option C is not the correct answer, is not the correct. It could have been correct if it states that enhancing qualitative characteristics includes the comparability, verifiability, timeliness, and understandability. So these are the enhancing qualitative characteristics. Are you getting the point? Yes, very good. Now, so it means option C is eliminated. D, it introduces materiality as an entity specific aspects of relevance based on nature only. Here, nature indicates the qualitative materiality. What do you think, guys? That in materiality, we are only discussing the qualitative nature, that is the qualitative materiality. Are we going to focus on the qualitative materiality only? Size or monetary values also matters, which states, which we call it as quantitative materiality. Quantitative materiality, are you getting a point? So here the nature only, this makes that statements an incorrect one. Now coming back to the B question, B requirement, that is a B point. B point, it does not override. Remember, let me give an example for this one, listen to me very carefully. Once we are reading the conceptual framework, once we are attempting the questions of conceptual framework, we have a term liability. Obviously, the conceptual framework discusses about the liabilities as well. Now, liabilities are basically the obligation that we need to record when the obligations has identified, so we need to record it. This is a simple treatment given by the conceptual framework, that what is liability and it should be recognized if the cost can be identified. So obviously we can recognize the liability. That is the conceptual framework states. But on the other hand, there is a standard, accounting standard IS 37, which states that liabilities are the obligation which must be recorded if all of these three criteria are met. Could you recall those three criteria? What were those three criteria? What were those three criteria? That there should be a present obligation. Remember, that there should be a probable, that is chances should be more than 50%. Yes, and the reliable estimate can be made. Remember? So it means now there is a contradiction. Now there is a contradiction. Conceptual framework states that if there is an obligation and the cost can be identified, just record it. IS 37 states that no, 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 no. This obligation will be recorded if the chances are more than 50%. So it means now there is a contradiction between the conceptual and the relevant accounting standard. Now, who will prevail? Now, conceptual framework states that the relevant accounting standard will prevail. Yes, it means the conceptual framework will not override. Conceptual framework will not overrule the IS 37. Are you getting a point? Yes, IFRS will win. IFRS will win. So it means in that particular statement number 2, it states that it does not override. Absolutely right. Any accounting standard or any requirement of the IFRS, it means conceptual framework never overrides an accounting principle. Never overrides an accounting particular accounting standard. Are we clear on this one? Everyone. Okay, now, these were the 4 questions that were identified by an examiner, and these were considered to be the most challenging one. Now, one OT case that is highlighted by the ACC examiner as well. One OT case in which obviously there will be 5 questions. So now we are going to perform that OT case. So we are going to have a one OT case, which is obviously a difficult one. Now, let's read the situation first, and then we will solve the questions related to that scenario. Timber company maintains thousands of acres land on which it grows trees, which are later harvested by cutting them down. Its year end date is 31st March. Okay, now it means they are growing trees, and later on these trees are harvested by cutting them down, and obviously they will be making woods and something else. Timber company primarily sells unprocessed harvested trees. It means the way I cut it down, these are sold. These are sold out. In March 2003, timber company harvested 800,000 cubic meters of trees at a cost of 56 at a cost of $56 per cubic meter. The sale price is $75 per cubic meter, and selling cost is $3 per cubic meter. Now, uh, first of all, can you identify that which accounting standard that we are going to discuss it over here? Yes, IS2 and IS41. Very good. Agriculture, as well as if it is harvested and if they are selling as a product, so it means inventory will also be included over here. Okay, nice. Very good. As a byproduct, timber company also sells 750 liter of bags of processed wood chips at a price of $185 per bag. The wood chips are the results of the processing of the harvested trees. It means they are making some chips like a wood chips, and obviously they'll be selling it for $185 per bag. Now, this is the entire situation. Let's move on towards the question number 5. And here it states that use the token. Okay, now use the token to ensure that the following statements are correctly described: agriculture, produce, and a biological asset. Now, before we move on towards the answer, let me have some discussion on it. That what do you mean by biological asset? What is biological asset? And what do you mean by agriculture produce? Yes, any one of you. What do you mean by biological asset? Very good. Biological acid is basically a living plant or animal. It's a living plant or animal. Biological acid is basically a living plant or animal. It's a living plant or animal that has the capacity of the biological transformation. This will obviously increase in the value or in the capacity. So it means a living plant or animal. Once the biological acid, if that biological acid has some product which is connected to that biological acid, this will be known as what the agriculture produce. This will be known as what the agriculture produce. Let me give an example for this one. For example, I do have a tree. First of all, is this the biological acid for me? I've made a wonderful tree for you guys. Yes, it's a biological acid. Now, uh, I'm making something else. You just need to identify that what I'm making it. Can you please identify that what do we have? What is this? Nice, Mohammed. Thank you so much. Thank you so much. It's an apple tree. Thank you so much, Mansoor, for recognizing my diagram. So it's an apple that is connected with the biological acid. So the output is connected with the biological acid. So this tree is a biological acid, obviously, and the apple which are connected with that biological acid, the output of the biological acid is known as what the agriculture produced. Now what happened? What happened that Mansoor came. Mansoor, here we have Mansoor. Let's make Mansoor over here. Mansoor we have, and there's a stone in his hand. The stone is hand, and what he did, he threw that stone to the apple. He threw that stone to the apple, and what happened that later on this apple. Now you can see the creativity. You can see the creativity of mine. So you can see that apple came down. So that apple came down. So that apple came down. Now earlier this apple was an agriculture produce, and once it is harvested. Yes, very good. Once it is harvested, now it's not a agriculture produce. Now this will be treated as an inventory. Now this will fall under IAS2. Are you guys getting the point? Yes, very good. So once the agriculture produce is connected with the biological acid, so this will be known as an agriculture produce. And for the biological acid and agriculture produce, IAS 41 is applicable, and IAS 41 states that we will recognize the biological acid and agriculture produce. The recognition would be the fair value less cost to sell. The fair value less cost to sell. However, the harvested apple, that is the inventory, for this we have IAS2, which shows and which says that now this inventory will be recognized at the lower of. So it means the recognition criteria for both the standard is different. Here it says that the inventory should be recognized at the lower of cost or NRV, while the IS 41 states that biological asset and agriculture produce will be recognized at its fair value less cost to sell. Are you guys clear with this one? Now, can you please answer this question? There are three blanks over there, and you need to identify that from which option. That is option number one, option number two, three, four, five, and six. There are six options and three blanks. So you need to fill up. Obviously, drag and drop will be done. So agriculture produce is the. Yes, agriculture produce is the harvested produce. Is the harvested produce. Is the harvested produce of the entities. Next blank. Yes, biological acid. Of the harvested produce of the biological acid. And what is biological acid? Biological acid is the a living plant or animal. A living plant or animal. Are you getting the point? Okay, now with this, we have another question. Now you please let try this one. In accordance with the IS 41 agriculture, IS 41 agriculture, how should each cubic meter of the harvested tree is measured? How it will be measured? Let me show you the scenario again. Okay, now here is the scenario, and this paragraph is relevant for that particular question. Timber company primarily sells unprocessed harvested trees. Timber company harvested 800,000 cubic meters of a tree at a cost of 56. It means the cost to cut down these trees is 56. The sale price is 75 per meter and the selling cost is 3 per meter. Now, what should be at what amount this harvested or agriculture produce should be recorded? It's C. Mansoor, it's C. Why? Because the fair value. We have seen that IS 41 states that the agriculture produce or the biological asset should be recognized at its fair value less cost to sell. Fair value less cost to sell. Yes, Almas. In the first initial and the subsequent recognition, Almaz, it's a very good question. Yes, Mansoor, it's a very good question. In many standards like in IS 16, IS 40, initially the IS says that you need to recognize at its cost, and subsequent measurement would be the fair value or the revaluation. But in IS 41 it states that the initial and the subsequent both recognition would be at fair value less cost to sell. The initial and subsequent recognition will be at fair value less cost to sell. In other standards, it shows that the first recognition should be cost, then you can recognize it on the fair value or the revaluation. But in IS 41, it clearly states that the initial and subsequent measurement should be at its fair value less cost to sell. Got the point, Almas? Okay, now let's have another question, and this time it is related to inventory. Yes, IAS 2. Now, in 31st March, Timber Company had 500 bags of wood chips. Remember, the byproducts are wood chips. 500 bags in inventory, that is 500 bags of inventory are there. During the year ended 31st December, the following overheads were incurred, like fixed production overhead and variable production overhead. The total is 378. The selling costs were estimated to be 1,63,500 for the units produced. It means that is a selling expense. Timber company absorbed overheads on the basis of unit produced, which for the year ended is 4,200 bags. It means total the production is 4,200. That was equal to the budgeted ones. Now what you have to do, you need to just calculate the total overheads that should be included in the cost of closing inventory. That's it. You're not supposed to calculate the total value of ending inventory. No, you just need to calculate that how much overheads will be included in the closing inventory. And remember, the closing units are 500. The closing units are 500. Okay, let's calculate it. So it means we have two overheads, and obviously we need to account for it. And obviously we are going to apportion it on the basis of unit produced. So the total fixed production overheads, we have 1,80,000, and obviously this is for 4,200, and the closing inventory right now that we have, the closing inventory right now that we have is 500. So it means for 500 units, the fixed production overhead would be, can anyone please calculate the value of it? 1,80,000 divided by 4,200 multiply by 500. So this will make 21,428. And same for the variable production overheads. Obviously, this will also become the part of your inventory valuation. So it's 1,98,000 in aggregate, and obviously this is for 4,200 bags that we have produced, and obviously we need for 500, and 1,98,000 divided by 4,200 multiply by 500. So this will make 23,571. So in aggregate, the total overheads that would be implemented is 21,428 plus 23,571, which will make 44,999, which is equal to 45,000. And triple zeros are already given over here. So I'm going to just type 45. Yes. Someone stated a different answer, I guess. Yes, Vajia, we can have an explanation for this again. Here, what you have to do, you are not supposed to calculate the total value of inventory. There are other material like direct labor, direct expenses, or direct labors are not given over here. You just need to calculate that how much amount of overheads will be included, how much amount of overhead would be included for 500 closing inventory. Like, what is the requirement that the total overheads that should be included in the cost of closing inventory? That how much amount of overheads will be included. So obviously the total overhead is 1,80,000. That is a fixed production overhead. And here it states that we normally incur the overheads on the basis of unit produced. So this 1,80,000 relates to 4,200 bags. So we are going to divide it by 4,200. And once you will divide it, Vajia, 1,80,000 divided by 4,200. So this will make 42.8. That will make 42.8, which shows that 42.8, it indicates that for one unit, the production overhead, the fixed production overhead is 42.8 for one unit. And how many units do we have at the end of the year is 500. So 42.8 multiply by 500. So this will make 21,428. Vajia, are you getting a point? Similarly, for variable production overheads, the total variable production overheads that we have is 1,98,000. And obviously, again, this variable production overhead is for 4,200 units. So once we are going to divide it, 198,000 divided by 4,200. So this will make 47.1. So for one unit, the variable production overhead is 47.1. So obviously for 500 units, we are going to multiply it. So 47.1 multiply by 500. This will make 23,571. So the total overheads that will be included to calculate the closing inventory would be 45,000. Vajia, are you getting a point? Yes, Mohammed. The simplest calculation could be this one. Very good, Mohammed. Okay, now let's move on towards the next question now. Yes, Vajia, we can do it directly as well. We can take the total overheads and we can multiply it by 500 units and dividing it by 4,200. Okay, now question number 8. Question number 8. Question number 8. Now there are three, and it is one of the most easiest question. One of the most easiest question. I think that you should not take more time on it. 10, 9, 8. Come on, answer me this question. Yes, these are all the latest examiner reports question. That is June 2025. Excellent, very good. Obviously, FIFO method, is it applicable? Yes, please reply me. FIFO method, is it applicable? Yes. Very good. LIFO method. Is it applicable? False. Weighted average. Very good. Very good. Weighted average. Yes, excellent. So it's true, false, and true. FIFO method is obviously relevant for us. LIFO method is no more applicable, and weighted average, yes, it's true. Now, the last question of this session now. Last question of this session. And obviously, last but not the least. Yes, ladies and gentlemen. Last but not the least, question number 9. Let's read the question first. At 31st March 2003, timber company has cut timber that has been processed and will be sold to building merchants in the year to ended 31st March 2004. For the preparation of the financial statement for the year ended 31st March 2003, it was decided to change. Yes, now there is a confusion or the problem that the inventory valuation method from cost formula A to B. Now, what is A? A is the current formula and the B is the new formula that we are going to impose. Now, obviously, inventory valuation that we are changing right now. And remember, please remember that if you're changing the inventory valuation that is from FIFO to FCO, so remember this is considered as a change in policy. This is considered as a change in policy. And if this is the change in policy, so obviously as per IAS 8, there will be a retrospective treatment. Are you guys getting a point? There will be a retrospective treatment. There will be a retrospective treatment that if there is a change in inventory valuation. But remember, if there's a change in the depreciation method or the formula or the cost or there's a change in the scrap value, so this is all considered as a change in estimate. But yes, for inventory, if there's a change in FIFO from FCO or from FCO to FIFO, so this will be considered as a change in policy. And for change in policy, IAS 8 states that there is going to be a retrospective treatment. Now, any one of you can please let me know that what is retrospective treatment? What is the retrospective treatment? We have to restate. Yes. Going back. Yes. We have to rectify the previous year data as well. Yes. Prior period should be restated. Very good. Last year's statement will also be restated. Yes. We do error correct in the following year. Reconcile. Very good. So it means that in the current year, that is 2003, obviously you are restating, you are changing the method, the cost formula. It means earlier it was this and now you're going to move towards this one. And obviously there will be a change. There will be a change. So this schedule is going to inventory valuation. This is basically the values of inventories. So if you are using the current formula, that is the previous one, so the inventory valuation should have been 184. But since if you will be adopting the new formula, the inventory valuation would be 1,82,000. So it means the ending inventory will be declined as compared to the previous formula. And in the last year, the analysis is also given. The last year, the previous formula was this, and if you adopt a new formula, so this will be the figure. Now, what is the requirement that what will be the impact on the cost of sales of the current year? It's not asking for the last year, but it says that what will be the cost of sales impact on the current year? What will be the impact on the current year due to the change in the inventory valuation method? Now, let me tell you one thing. First of all, let's take the last year because we know that it's a retrospective treatment. In the last year, if you have calculated the merchandise ending, and obviously in the last year, the data for the last year is this. If you have calculated the inventory using the last year formula, 1,67,700, right? But now, obviously, if you're changing the method, so you have to restate your last year figures as well. So it means last year ending inventory was recorded at 167. Now it should have been recorded at 164. So it means last year ending inventory 3,600 was understated. Or we can call it as overstated. Yes, we can call it as overstated. Why? Why? Because you have recognized as ending inventory as 167,700, but it should have been 1,64,100. I repeat, last year you have recorded the ending inventory at 167,700, but this time it should have been recorded as 164. So it means you have overstated the ending inventory, right? So last year ending inventory is overstated. So if the last year ending inventory is overstated, so if this error or if this impact is carried forward, so in the current year, obviously this ending would be considered as opening inventory, right? And if the last year ending inventory was overstated, so obviously this year the opening inventory would be overstated. If the last year ending inventory was overstated, so obviously the opening inventory in the current year is also overstated. Are you guys getting the point? Please, everyone, notify me. This is not the very simple question. It is something which is technical, so we need to understand it. Everyone, please participate. Let me repeat it again. That first of all, we are going towards the last year. We are reviewing the last year first of all. First of all, we are taking last year data. In the last year, the closing inventory which you have calculated, which was method that we have followed, was 1,67,700. You have calculated the ending inventory, and obviously you must have finalized your accounts. Since we have made or we are changing the method in the current year, last year it was recorded with 1,67,700. But in the current year, yes, Malik, I'm explaining this concept again. Let me repeat it again. Okay. Now, focus on it. What is the problem here? That last year we were using the different formula, different method, and in the current year we are using the different formula, different method. Now, first identify the last year and the current year. The current year is 20x3 and the last year is 20x2. So we were opting a different method in the last year, and obviously in the current year we have changed the method. Now remember, if the inventory valuation is changed, like from FIFO to FCO or from FCO to FIFO, this will be considered as a change in policy as per IS 8, and this will have a retrospective impact. Now, retrospective impact means you have to change the prior year data as well. You have to restate the last year values as well. You need to correct, it means you need to apply that change in such a way that it is implemented right from the beginning. So it means you cannot say this one that since we have already made the financial statement for the previous year, so let it be. No, this will not be the case. Obviously, you have to restate the values of the previous year. Now, what you have to do, first of all, let's account for the last year data. In the last year, the current formula that you were using, according to that one, the ending inventory, the valuation of inventory was 1,67,700, which you have already recorded in the last year. That was perfectly fine. But since now we are changing the method, so obviously you need to restate the values of the previous year. And if you take the value from the different methods, so it should have been 1,64,100. Remember, in the last year, you have recognized the ending inventory at 167,700, and as per the calculation of the new method, as per the calculation of the new formula, it should have been 164,100. It means in the last year, you have overstated the ending inventory. And remember why I'm considering the last year, because it's a retrospective treatment. So obviously I have to consider the last year data as well. So it means in the last year, your ending inventory was overstated by 3,600. Your last year ending inventory was overstated by 3600, and we know that the ending inventory for the last year is basically the opening inventory for the current year. So if the ending inventory is overstated in the last year, so obviously the opening inventory for the current year is overstated. Please do let me know if it is clear to you or not. First, do let me know and confirm me whether it is clear to you or not. Okay, great. Now, if the opening inventory now in this exam, in this particular question, he's only asking you for the current year, that what will be the impact on cost of sales for the current year. So we are not bothered about the last year. So just skip that one. Just skip that one now. Now we have to focus on the current year data. Now we have to focus on the current year data. That if the opening inventory is overstated, so for the current year, the cost of sales, if the opening inventory is overstated, now you guys just let me know that the cost of sales will be overstated or understated. Yes, if the opening inventory for the current year is overstated, so whether the cost of sales would be overstated or understated. It's overstated, Mansoor, because if the opening inventory is higher, if the opening inventory is higher, so obviously the cost of sales would also be higher. There is a direct relation with the opening inventory and the cost of sales. So if the opening inventory is overstated, so obviously the cost of sales will also be overstated. So it means that opening inventory is overstated by opening inventory is overstated by 3600, which means that obviously the cost of sales is also overstated by the cost of sales is also overstated by 3600. Are you getting a point? Okay, now let's move on. Let's move on. Now let's come back to the current year data. In the current year, the closing inventory that should have been accounted for as 182, and it should have been 1,84,000. It means that 1,84,000 was recorded in the current year, but as per the revised formula, it should have been 182. It means again, here the ending inventory at 31st March 2003, ending inventory at 31st March 2003 is again, as per the current formula, if we compare it, so it is again overstated by 1155. It is again overstated by it is again overstated by 1155. Are you getting the point? Yes, again the ending inventory is overstated. So if the ending inventory is overstated, ending inventory is overstated by 1155. If the ending inventory is overstated by 1155, so the cost of sales, ending inventory is overstated by 1155. So the cost of sales, will, will, The cost of sales will be, if the ending inventory is overstated by, if the ending inventory, remember, please remember the relationship. Merchandise opening and cost of sales have a direct relation. If the merchandise opening would be higher, so cost of sales would be higher. While as the merchandise ending and cost of sales has an inverse relation, it's an indirect relation. So if the ending inventory is higher, so obviously the cost of sales would be lower. Yes. So it means the cost of sales would decrease. The cost of sales would decrease. So it means that because of this transmission, the net impact would be 3600 minus 1155. Can you please let me know the difference of it? Because the one side is increasing, the other one is decreasing. So it means the net impact would be, can anyone please calculate the net impact of it? 3600,
2445, sir.
2445. 2445. Very good. Now, because of which, now what will be the impact of it? Because of this transmission, what will happen? What will happen that the cost of sales will increase by 3600, and the cost of sales on the other hand will decrease by 1155. So it means there will be a net impact of 2445. This will increase the cost of sales. Now what we have to do, that we need to adjust the cost of sales by reducing 2245, sorry, 2445. It means now what will be the impact of the cost of sales? Now remember, please let me recall it. Let me recall it. That because of this transition, there are two impacts. Number one, the last year closing inventory and the current year closing inventory. The last year closing inventory that was recorded as 167, either it should have been 164. Because of this error, there was a difference of 3600. It means last year ending inventory was overstated by 3600, which means last year ending inventory was overstated by 3600. So it means the opening inventory was opening inventory was also overstated by 3600. Now this is something that we are identifying the issue, the point issue that we are identifying the issue, that because of this last year ending inventory, the opening inventory was overstated, and if we compare the closing inventory for the current year, so again it is overstated by 1155. So it means the ending inventory for the current year is also overstated by 1155. So it means the net impact would be 2445. By this, the cost of sales is overstated. Cost of sales is overstated by 2445. Now, what is the requirement of this question? That what is the impact on the cost of sales for the current year due to the change? That what we have to do, that we need to reduce the cost of sales by 2445. Are you guys getting the point? Yes, option B is the correct one. Option B is the correct one. 2445. 2445, that is the decrease in the cost of sales. So these were the questions that from the March, June 2025, and these were the examiner report. These were the official past paper questions that the examiner has tested in their previous exams. And obviously, few were very challenging, few were very simple. But this is something that you need to learn, that you must have a grip in all the accounting standard. As I told you, that you can see that there are questions from IS2, from IS41, although these are the very small standards, petty standard, but obviously the examiner is testing from these areas as well. So you have to prepare yourself for these areas as well. For this, what you can do, Let me share you my contact number. For those who are already my student, they can definitely text me around. What you can demand from me. I'm also sharing my email address, and let me tell you the purpose of it. That is my contact number and my Gmail ID. And what you can expect that I can send you the past examiner report questions along with their answers, along with their explanatory videos. Second, what you can expect from me, that I can also give you an assistance in your ratios. That uh, you just send me the question, but obviously this will be done through email address. Okay, please don't WhatsApp me. Ratios, you can send me the question that you have tried, and if you have the suggested answer for that question, so you can also send that suggested answer, like if it is a past paper question. And send me your word file, and all of these three documents should be in word format, please. Word file, send me three documents. Number one, the question that you have attempted, suggested answer if there is any, and your solution, your draft, what the answer that you have drafted, you can send me, and within inshallah 10 to 12 hours I will respond you back and will let you know and will give you a comment, a detailed comments that how you are performing right now and what are the loopholes. It's Junaid Khalid 16 at the rate gmail.com. Junaid Khalid 16 at the rate gmail.com. Junaid, let me write it more clearly. Junaid, Junaid, Khalid, Khalid 16 at the rate gmail.com. Thank you so much, Mohammed, for your assistance. Okay, this was all from my side. I wish and I pray for all of you that may you get, may Allah subhanahu wa ta'ala help you in your preparation and you get and you score very good marks in that particular paper. But do let me know that how was the session. Obviously, you can text me, you can email me, you can show your feedback over here that how was the session, and did you got uh, anything from this session. You can definitely send your feedback, a detailed feedback, on my WhatsApp as well, or you can also send an email. So I wish you all a very best of luck. Thank you so much for joining this session. May Allah bless you with a tremendous success. Thank you so much.